Hey guys, Jay here. This is smarthelping.com. I've got a brand new financial model template for you this morning. Well, it's actually it's an LBO model, but it's got some heavy modification on the acquisition logic and the amount of debt and the types of debt you can use to finance the project. Um, the core logic is the same as far as how you're deriving revenue, options for receivables, variable costs, inventory, payables, fixed costs, capex, all that stuff is the same as the original. But what's been added, and this all is integrated into the three statement model, income statement, balance sheet, cash flow statement, all over here, and the debt service coverage, which is very important for a leverage buyout, uh, is all updated with this new logic here for how you can finance a project as well as how you derive the EBITDA multiple if you're going to use EBITDA multiple. There's also an exit schedule, which is kind of nice. It's almost like a sensitivity to see what, based on the different EBITDA multiple here, what your exit profile looks like at each year based on the amount of debt you owe, the equity stake, if any, that's owed to the seller, and the valuation, obviously, and then the net exit payout. So we'll talk about some things. New terms: equity stake, retained. That's going to be a new one. But let's just dive into the main changes. So up top, nothing really different here. Just general assumptions about the model, how long you want to go for, up to 15 years. If you're going to include the exit or not in cash flows, and the exit valuation you want to use either EBITDA or revenue multiple, and the multiple. Um, Now, starting with the acquisition method, you can use EBITDA, revenue, seller's discretionary earnings, discounted cash flow analysis, average of all of them, or your own input, and that will derive your purchase price, whatever you pick. Now, the main change with this is EBITDA multiple. You now have a historicals tab of up to 10 years historicals. You can plug in about the company you're purchasing, and you can define either a top-down or a bottom-up style to get to EBITDA. The top-down is basically starting, you just pick the row that's net income, and then you have add backs for income taxes, irregular income or expenses, depreciation, and interest. So that's a top-down style, and then bottom-up is where you're deriving the components of EBITDA. So here you can actually define what you are counting as revenue, cost of goods sold, OpEx, um, a couple other labels here. You can do depreciation, amortization, irregular expenses, interest, income tax, and go all the way down to net income here. But the only relevant row is EBITDA adjusted. That's what you're going to use. And so whichever method you pick, top down or bottom up, it'll throw the EBITDA in there. On the EBITDA tab, you can do up to 10 years here, and it's going to give you a weighted average EBITDA based on which method you choose. This is showing you the logic for the top-down style, but if you choose bottom up, so here's top down is going to match with this, but if you use bottom up, it's actually just going to pull whatever's in this row, and everything above this would be irrelevant in that case. But the main thing we're trying to get to is a normalized EBITDA number that we can apply to a multiple to get a acquisition purchase price. So toggle between those. Um, That's the main difference on the acquisition method. Now, here's where we really get fun. And if you like financial modeling, this is pretty cool. So a lot of components we've added here. So we've derived a purchase price of the target company. The first input here is we can put the percentage of that the seller, if any, is going to retain in equity. So if it's 25%, that means of the purchase price, 25% is going to be retained by the seller. So you only have to pay as the purchaser of the company 4.1 million, and then on exit the seller of the company that sold to you will get to keep 25% of those profits. There's probably a lot of different ways you could structure this deal, but this is a high level way to just plug in some numbers and see what that does to your cash flows if the seller retains some equity and then they get a portion of the exit value based on whatever percentage you put in here. So purchase price, amount financed with seller equity, and we've got, I think, 6 or 7 financing options. So we've got seller equity retained as the first one. Then remaining amount that needs to be financed, we can go seller financing. We can do a traditional bank loan 2, And you can define the terms of all these on L1 through L3, and all of them have the option to be interest only. You've got extra principal repayment. Here's your terms up here they can adjust, and then you can convert it to a term loan also with its own interest rate schedule. And that's how the two traditional bank loans work, the seller financing option and two bank loans and the working capital loan. So if we're back on here, so of the finance amount, we can say, okay, some percentage is going to be seller financed, go through that debt schedule, and the percentage, some amount is going to be traditional bank loan 2, and then the remaining we've got finance with equity. And now this amount is a pulling from the model, because this also includes if you have burn, acquisition fees, other things besides the purchase price that's going to require you to contribute equity as the purchaser, so you have enough cash to run things. You got a working capital loan as well, and then you've got line of credit. Now the line of credit in L5 is if you're going to borrow over time, meaning it's not all happening at once, and then at some point in the future, based on the IO period and the month you switch, this can convert to a term loan as well. So if I were to say, okay, I want to borrow 100,000, another 100,000 for the first few months to get going on operations, I pay interest on that. And then if the interest only period is 18 months, you see you've got interest only starting here, and then I need to match up when this starts with the end with the month of switch. So it'll just be, we got, let's see, 18 months. So here, so in theory now, since I started in month 2, the month of switch should be month 20. So I would adjust this to 20 in this case. And now we've got a refi amount or a conversion amount to a regular P&I loan with these new terms. Probably not 25% interest rate, maybe 8%. And then it goes for these terms. You could do a 5-year loan with a bullet at the end of the 5th year like this. Everything stops. These are very dynamic amortization schedules. The best I've ever done. So those are all the different ways you can finance the project. Now let's say you didn't want to do any seller retained equity here. You could always put 0%. And then these percentages would be the amount of the purchase price that you're financing. But let's say we did 25% with seller equity remaining, 25% seller financed. What else how much do we have left? So 25. And then of this, let's do 25, 50 on the second one. And then another 25, zero this out. And then let's say there's no acquisition fee. Now look, finance with equity 366. This actually is probably the net burn. And you can see on the executive summary, I did add a sort of source and uses where you can see the purchase price, any burn, and then you can see all our sources of equity here. Equity, line of credit, traditional bank loan, seller finance, seller equity. So if I go here, let me zero out the line of credit. See what this looks like. So we're still at 663, which would be burn. And that's going to come right from the monthly detail on the cash flow row here. Okay, so we're profitable near one, so we got some accrued taxes. Let me zero out the taxes. You can only show a pre-tax number. Okay, there we go. So if I zero out the taxes, there's no other burn. So in this case, I'm actually not required to have any equity because we financed 100% of it with these different methods. Now let's say you only did 25% for all these. Well, you're going to need a little bit more of the purchase price financed with equity. I really think this is one of the most dynamic and intricate LBO models I've ever done. I think it's super useful for a very broad case. When you get into the operations, revenue is going to be, you've got 4 options for revenue, but it's all pretty standard at a high level. There is some seasonality here if you want to do seasonality. The others are just simply a starting amount and then a annual growth rate or a monthly compounded growth rate. and then you can compare the different revenue streams here. But it's not too complex on the revenue. You could also define the start month. Receivables, just the percentage of the amount of revenue you collect that's paid on account, and then based on that, you can have a collection schedule. So that is important for businesses heavy in receivables to do the cash flow at the first year. Then you've got variable costs. Now, variable costs, you can mark one of its inventory. That'll affect the inventory in the balance sheet, and payments for inventory as well, and payables. But every section of cost of goods sold has two components. One is the percentage of the total revenue that applies to this. So this is saying, let's say only 50% of your revenue will have this variable cost. You put this at 50%, and then it'd say, okay, of your revenue, 50% is going to have a cost of this amount of whatever the variable cost is. So if I had $100 in revenue and I were to put this at 50%, that means of the $100, 50% is subject to this cost, and that cost is 25% of that amount. So in this case, it'd be $12 of the 100 if I put in 50% and 25. And that works the same for all these different ones. Fixed costs, these are just define the description, the start month, and the fixed cost by the monthly amount of that cost. You can adjust it over the 15 years. I did add a PP&E section, so just a fourth section of fixed costs here. CapEx is the same. Any costs, the useful life, the month of expenditure, this will drive depreciation. Other one-time startup costs or fees. Terminal values just for taxes. If it's a fixed asset heavy business and you exit, maybe you want to apply some of the exit proceeds to fixed assets rather than extraordinary income, which is just going to drive what's taxed at your income tax rate versus capital gains tax. Cap table. So the top here is going to be your total equity requirement. So if you are required, going to have to put in some cash injection here. You can say if you're going to have outside investors or inside investors and the amount they're investing and the percentage they get. Note the total in column C for these two should always add up to whatever this is. And I've put a fill box in this one to fill if you haven't put in anything else. And these percentages here should always add up to 100% in total when you add both columns in the top and bottom section. For each row, there is an IRR calculation. Taxes, exit, talked about that. Executive summary is going to show you your high-level items, revenue, gross profit, fixed costs, your EBITDA, and then other cash flow items. So like here's the seller equity offsetting some of that purchase price, inventory add backs to reconcile the cash flow for those, receipts versus receivables, the actual purchase of the business initially, loan proceeds, interest, principal payments, total debt service, and then very important here, debt service coverage. Going to compare your operational cash flow to the debt service. The running cash position, and then like we went over this, our sources and uses. Here's a IR and equity multiple summary, return summary for the project, as well as the investor and owner group. Investor group would be like on this cap table, the top section as a whole, and the bottom section would be the owners. Visuals, just high-level visuals here. Debt service coverage is a good one. You're going to pay attention to that, but just high-level cash flow, revenue, gross profit, gross margin. Monthly details where you can see how everything kind of comes together from revenue all the way down. Fixed costs, well, there's variable costs up here. Fixed costs, financing, debt service, financing proceeds, cash flow, helper calculations, and then a monthly convention, IRR. Now I put in dummy numbers, so this doesn't mean anything here, but when you put in your real numbers here, you'll get some things here that make more sense as far as the output. And then annual detail, same deal as monthly, but an annual basis. Distributions, this is a discounted cash flow analysis for the project as a whole. It's going to do all that, any equity required is going to come out, and then all remaining distributions you'll be able to see, including the exit if it's included. The discount on the cash flow, the discount rate is actually pulling from the acquisition tab. And then here's the investor and owner summaries as well. And you can put in their discount rates. You can use weighted average cost of capital or what have you. And then finally, the financial statements, these all come together and match. So you got the cash flow statement feeding into the cash flow of the balance sheet. You've also got inventory, accounts receivable, other current assets. If you put anything on that CapEx tab, it'll come in here. There are some other things like assets, goodwill. This is nuanced based on the acquisition tab. You get to find the percentages for that, but it all will balance out based on the logic I've already built in. Total assets, all your liabilities, long-term debt you're going to pay attention to. Then equity, seller equity. So this is if you sell, if the seller retains some equity, then that stays in here. This is your contributions of equity to acquire, retained earnings, and then you've got owner's equity, total liabilities, owner's equity, and then assets, and these always have to equal per the accounting equations. Pretty robust here. If you're into accounting, if you're into financial modeling, or if you want a really nice acquisition model, this is it. This does a lot of things at a high level. Income statement here, and the net income will flow over to retained earnings on the balance sheet. That's basically what this is going into, but you can also see, how the operations are doing based on all your different assumptions over time. And these go out for 15 years, monthly and annual. All right, that's the model. If you're a private equity firm, venture capital, looking to acquire businesses with debt, this is quite a tool to use. And the purchase link, if you want to download this, will be in the description box below. I'm going to include it as, let's see if we go to the valuation models. This is, I've done a couple LBO models. This is the original that I just modified. So you can see here, this is the old version. It's got quite a addition of things with acquisition, financing, and historical data of the target company. So pricing wise, this was $45 one-time fee. It's included in the valuation model bundle, which is only $99, so it's all fair. But this specific model, I think I'm only going to include it here as an advanced version. You can only buy it on this tab. It's actually not going to be included in any bundles except for the all models bundle or the super smart bundle for $9.99. So I will include it in this, which is just all the templates on the whole site. But other than that, the only other place you'll be able to buy it is right here on the leverage buyout model robust template for LBO acquisitions. This, and it'll be an advanced version. I'm going to put it probably the screenshots and the video just right down somewhere around here. So you can buy it, and it'll be pricing wise, it's going to be more than 45. I don't know exactly. I'll have to see how I want to price it. We'll have to think about that some more, but that's how you can get it. It'll be uploaded today and available. Trying to think if I want to include it in any other bundles. I think actually I'll also include it in the industry specific bundle for $2.99 because these are there's a lot of bottom-up financial models here in a bunch of different industries, but I think it makes sense to put the LBO model in here as kind of an add-on. So we'll add it to that as well as the super smart bundle. And again, if you want to find it, just go to the home page, valuation tab, LBO model right here. And it'll be in the, to buy it and download it, it'll have a separate add to cart button. Pricing wise, I think I might just go 99 bucks on it for if you want to buy it individually. Alrighty, well, I hope you guys enjoyed. Like and subscribe, and before I forget, you can hire me for custom work. My current rate for new customers is $275 an hour. I will be probably converting everybody existing customers will still have the $195 rate for at least 12 months from when I increased this, which was about 3 days ago. But new clients, rate's $275 an hour, and usually I do 24 to 48 hour turnaround. Oh, and you can get template discounts. I always forget to mention this. If you want to buy templates 3 to 9, the cart will automatically give you a 30% discount. If you buy over 10, you get a 40% discount on the whole purchase price, and over 20, you get 50% discount. And in this, you can buy bundles. For example, if I wanted to buy a SaaS bundle, okay, that's $289. Continue shopping. Let's say I also wanted to buy the real estate bundle, add that to cart, okay, and I would continue shopping. And let's say I wanted to also buy the industry specific bundle. Okay, now you see there's an automatic discount here of $266, which is the discount after there's 3 items in the cart. So you can get all 3 bundles instead of 2, 4, 6, 7, 8, 900. You get it for $620. That applies to bundles. It applies to individual templates. You see there, I've added it. Any amount of items in your cart, or anything you get in your cart, that discount structure will apply. Alrighty. I will see you on the next one.